You know that feeling when you finally decide to jump into the market? You have been watching from the sidelines, maybe for months, listening to your coworker Brad talk about how he made a killing on some tech stock or a dog-themed cryptocurrency. You are sitting there, eating your lukewarm lunch, feeling this rising panic that you are the only person on Earth who isn't getting rich. It feels like a cosmic conspiracy where everyone was handed the script except you. So, you finally do it. You open the app, your heart is pounding a little bit, which is ridiculous because you are just tapping a screen, but it feels like you are diffusing a bombshell. You put $1,000 in. You buy the thing Brad told you to buy. And for like 2 days, it goes up. You feel like a genius. You are basically Warren Buffett. You start mentally spending the profits. I'm going to buy a boat, you think. I'm going to retire at 35. And then Tuesday happens. You wake up, check your phone, and the line is red. Like really red. It is diving straight down. Your $1,000 is now $800. Then $700. You feel this cold, heavy rock settle in your stomach. You close the app in horror, thinking if you don't look at it, maybe it isn't real. But you check it again 5 minutes later. It is worse. You panic. You think, I knew it. I knew I was too stupid for this. The system is rigged. So you sell. You take the loss just to make the pain stop. And then 3 weeks later you look back and the stock is at an all-time high. If you had just done nothing, literally nothing, you would be up. But instead you locked in a loss and you are sitting there feeling like the universe just reached into your pocket and stole $300 just to teach you a lesson. It is frustrating. It is humiliating. And honestly, it is the reason why 90% of people fail at investing. They treat the stock market like a casino where the goal is to beat the house when actually, the market is a machine designed to transfer wealth from the impatient to the patient. Most people think investing is about picking the right stock. It is not. It is about managing your own psychology so you don't set your money on fire when things get scary. Today, we are going to break down exactly why almost everyone fails, looking at the brutal math and the weird wiring in our brains that sabotages us. And we are going to give you the blueprint to be in the 10% who actually win. I am Ryan, and welcome to Finance with Ryan. Let's stop losing money. We need to reframe the problem because we have been fed a lie about what investing actually is. We think investing is an IQ test. We think the people who make money are the ones who can read complex charts, analyze balance sheets, and predict what the Federal Reserve is going to do next Tuesday. But that is a misconception that keeps you poor. The truth is, investing is not an IQ test. It is a temperament test. There is a famous study by a company called Dalbar. They look at investor returns versus market returns. Over a 30-year period, the S&P 500, the index of the biggest companies in America, returned roughly 10% per year. But the average investor in equity funds, they returned less than 4%. Think about that. The market gave 10%. The people in the market got 4%. How is that even mathematically possible? How do you underperform the thing you own? It is because of the scarcity mindset and the contrast principle. When the market drops, our lizard brain screams, "Scarcity! Resources are vanishing! Run away!" We sell low because we are terrified of losing everything. We are wired to prioritize avoiding pain over gaining pleasure. This is called loss aversion. Losing $100 hurts twice as much as finding $100 feels good. Then, when the market is flying high, the contrast principle kicks in. We see our neighbor making money. We contrast our boring savings account with their exciting returns, and we get greedy. We buy high. So we end up doing the exact opposite of the golden rule. We buy high because of greed, and we sell low because of fear. We are basically running a charity for Wall Street. We view the stock market as a line on a chart that wiggles. But that is the wrong metaphor. You need to reframe it. The market isn't a line. It is a collection of real businesses. When you buy an index fund, you are buying a piece of Apple, Microsoft, Amazon, Walmart. You are buying the productive capacity of human civilization. If the price of Amazon stock drops 20% tomorrow, did the warehouse disappear? Did the trucks stop running? Did people stop buying toothpaste and chargers? No. The business is fine. The price is just a mood swing of a bipolar neighbor. Most people fail because they are reacting to the price, not the value. They are like a homeowner who checks the zestimate of their house every hour and panics if it drops by $1,000. That would be ridiculous, right? You would lose your mind. But that is exactly what we do with our portfolios. We have to understand that volatility, the ups and downs, is not a bug in the system. It is a feature. It is the fee you pay for higher returns. If you want safety, you get 2% in a savings account. If you want 10%, you have to accept that sometimes the line goes down. The 90% who fail are the ones who try to get the 10% return without paying the emotional admission fee. They try to sneak into the theater and they get kicked out. Let's get into the mathematical proof, because I want to show you exactly how much this behavior costs you. It is not just a few bucks, it is millions. Let's look at the cost of timing. A lot of people think they can outsmart the market. They say, "I'll wait until the crash to buy," or "I'll sell now before it drops." Let's look at the numbers from 1990 to 2020. That is 30 years. If you invested $10,000 in the S&P 500 and just left it there, you went into a coma, you forgot your password, you did nothing. That $10,000 turned into roughly $170,000. Not bad for doing nothing. But let's say you tried to time it. Let's say you got scared and missed just the 10 best days in the market over those 30 years. Just 10 days out of nearly 8,000 trading days. Your return drops by half. You end up with roughly $85,000. You lost $85,000 because you missed 10 days. If you missed the 20 best days, you end up with only roughly $50,000. If you missed the 30 best days, you end up with roughly $30,000. Your returns are decimated. And here's the kicker. The best days usually happen right after the worst days. When the market crashes, it usually snaps back violently. So if you sell when it crashes, on a bad day, you almost guarantee you will miss the rebound, the best day. You are literally mathematically guaranteeing your own failure. Now let's talk about the goal gradient effect and compounding logic. Compounding is backloaded. It is unfair. It is slow. If you invest $500 a month at 8%, in year one, you have $6,000 saved and earned maybe $200 in interest. It feels pathetic. You think, why am I bothering? This isn't working. This is where most people quit. They don't see the results, so they stop. But look at year 30. In year 30 alone, that same portfolio earns roughly $50,000 in interest. You earn more in interest in 1 year than you contributed in 8 years at the beginning. The 90% fail because they judge the results of compounding linearly. They look at year 3 and say, "I'm not rich yet. This is a scam." They don't understand the acceleration framing. The first $100,000 is the hardest. It takes the longest. The second 100,000 comes faster. The third, even faster. By the time you have 1,000,000, the next 1,000,000 can happen in just a few years. It is like pushing a boulder up a hill. For the first 10 years, you are sweating, you are groaning, you are moving inches. But once you crest the top, the boulder starts rolling on its own. Most people give up 5 feet from the top of the hill. They turn around and let the boulder crush them. Let's look at the numbers of fees, too. This is another trap. If you pay a financial advisor 1% to manage your money because you are scared to do it yourself, 1% doesn't sound like a lot, right? But over 30 years, that 1% fee will consume roughly 1/3 of your total investment returns. If you would have had $1,000,000, you now have roughly $700,000. You paid $300,000 for someone to likely underperform the market. That is the cost of ignorance. That is the cost of fear. The math proves that the winning strategy is the boring strategy. Low fees, consistent contributions, and absolutely zero timing. The math proves that doing something usually subtracts value, while doing nothing adds value. In investing, laziness is a virtue. This leads us to the psychological shift. The math is clear, but you are human, and humans are emotional messes. To succeed, you have to undergo a complete identity shift. You have to shift your identity from gambler to owner. A gambler is looking for a jackpot. A gambler needs action. A gambler gets a dopamine hit when they place a bet and another one when they win. An owner is boring. An owner cares about cash flow. An owner thinks in decades, not days. You also have to shift from consumer to capital allocator. Most people get their dopamine from spending. I bought a new phone. Look at me. You need to rewire your brain to get dopamine from having. I own shares of the entire global economy. I am safe. This requires immense discipline, but not the kind of discipline you think. It is not the discipline to wake up at 4 a.m. and stare at charts. It is the discipline of indifference. It is the discipline to be bored. Let me give you a before versus after of this mindset. Before, the 90% mindset. You check your portfolio every day. You have CNBC on in the background. You read articles titled 5 Stocks to Buy Now. You feel anxious when the market is red and euphoric when it is green. You are constantly looking for the next big thing. You feel like you need to do something to fix your finances. When the market drops 10%, you think, my money is disappearing. I need to stop the bleeding. You sell. After the 10% mindset, you check your portfolio once a quarter, mostly just to rebalance. You have no idea what the S&P 500 did today, and you don't care. You have automated your investments, so the money leaves your checking account before you even see it. You view your portfolio as a storage locker for your freedom, not a slot machine. When the market drops 10%, you think, oh, stocks are on sale. My automated contribution tomorrow is going to buy more shares for the same price. Nice. You do nothing, or you buy more. This is cognitive reframing. You stop seeing a market crash as a loss and start seeing it as a discount. If you went to the grocery store and steaks were 50% off, would you run out of the store screaming, my steaks are losing value? No. You would fill your freezer. You need to treat stocks like steaks. If you are a net buyer of stocks, which you are, if you are saving for retirement, you want prices to stay low. You want to accumulate shares while they are cheap. Bull markets, when stocks go up, make you feel good, but bear markets, when stocks go down, are where you actually get rich. The identity shift is realizing that you are playing a single-player game. It doesn't matter what your neighbor is doing. It doesn't matter what the crypto kid on TikTok is doing. It matters what your plan is executing. You have to develop a thick skin. You have to be willing to look stupid in the short term to be wealthy in the long term. While everyone else is bragging about their gains at the barbecue, you are quietly smiling, knowing your boring index funds are compounding in the background, unkillable and inevitable. So what are the practical implications of this? How do you actually live this way without going crazy? It starts with creating bargaining power via your BOTNA, best alternative to a negotiated agreement. The practical result of successful investing isn't a Lamborghini. It is walking away money. When you invest consistently and avoid the mistakes of the 90%, you build a gap between your lifestyle and your income. This creates a positive feedback loop. Because you have savings, you are less stressed. Because you are less stressed, you make better decisions at work. Because you make better decisions, you get promoted or earn more. Because you earn more, you can invest more. The flywheel spins faster and faster. The 90% live in a negative feedback loop. They spend everything. They have no savings. They are stressed. They make panic decisions with their money, trying to get rich quick. Because they feel desperate. They lose money. They get more stressed. The practical shift is spending your mental energy on your income, not your portfolio. Most people spend hours researching stocks to try and squeeze out an extra 1% return. If you have a $10,000 portfolio, 1% is $100. You spent 10 hours to make $100. That is $10 an hour. You are working below minimum wage. If you took those 10 hours and learned a new skill, or worked overtime, or started a side hustle, you could make $1,000. Then you dump that $1,000 into the boring index fund. That is how you win. You focus on the shovel, your income, not the pile of dirt. We also need to implement a spending shift. You stop buying liabilities to impress people. You realize that status is a trap. The guy in the BMW might have a $500 net worth. The guy in the Honda might have $2 million. You want to be the guy in the Honda. You use your money to buy assets that pay you. You buy dividends. You buy equity. You buy freedom. You stop feeding the contrast principle beast. Practically, this means automate everything. Remove the human element. If you have to decide to save, you won't. Make it automatic. Delete the apps. Seriously, if you have a trading app on your phone that sends you notifications, delete it. You don't need to know that Tesla is down 2%. It is noise. Create an investment policy statement. This is a fancy way of saying, write down your plan. I will invest $500 a month into a total market index fund. I will not sell unless the world ends, in which case money doesn't matter anyway. I will rebalance once a year. When the panic hits, and it will hit, you read the paper. You follow the instructions you wrote when you were sane. Now, I have to give you a serious warning. There is a specific moment where even the smart people fail. It is the "I've made it" trap. Let's say you do everything right. You automate. You wait. You hit your first $100,000, then $200,000. You are feeling good. And then you get bored. Or you get overconfident. You think, man, I'm pretty good at this. Look at my account. I bet I could do even better if I picked a few individual stocks. I bet I could time the top. Don't do it. This is the siren song that crashes the ship. Success in investing breeds complacency. You start to think your returns are due to your brilliance, not the market's performance. So you take your boring, safe, compounding machine and you start tinkering with it. You buy a boat. You buy a vacation home you can't afford. You put 10% into a buddy's restaurant idea. And just like that, you introduce opportunity cost that destroys your momentum. If you take $50,000 out of your portfolio at age 40 to buy a luxury car, you aren't spending $50,000. At an 8% return, that $50,000 would have been $340,000 by the time you retired. You just drove a $340,000 car. Was it worth it? Probably not. The vivid comparison is this. Imagine you are planting a forest. For years, it is just saplings. You water them, you protect them. Finally, the trees start getting big. They start providing shade. And then you decide to chop them down because you want firewood for a bonfire tonight. You trade decades of future growth for one night of warmth. It is stupid. It is ridiculous. But people do it every day when they cash out their 401k to pay off credit cards or to pay for a wedding. Do not eat your seed corn. The warning is, the boring path is the only path. The moment you try to make it exciting, you step onto the path of the 90%. Look, I know this isn't what you probably wanted to hear. You wanted a stock tip. You wanted a secret code. You wanted me to tell you that if you buy this one crypto coin, you will be a billionaire by Tuesday. But I respect you too much to lie to you. The reason 90% of people fail is because they are looking for magic. There is no magic. There is only math. The transformation I want for you is to stop being a victim of the market and start being a master of it. I want you to experience the peace of mind that comes from knowing you have a plan that is mathematically guaranteed to work if you just get out of your own way. Contrast the old mindset. I need to get rich quick or I'm a failure. With the new mindset, I am getting rich slowly and nothing can stop me. So here is your next step. Start building that foundation today. Log into your account. Set up an automatic transfer for the day after your payday. Make it boring. Make it invisible. And then? Close the app. Go for a walk. Live your life, because the best investor is the one who forgets they are investing. Thanks for watching Finance with Ryan. If you are ready to be in the 10%, hit that like button. It's the best investment you can make. And the returns are tax-free. I will see you in the next one.